Premium. A premium is the payment someone makes to keep their insurance policy active. It can be paid monthly, quarterly, or annually, depending on the agreement. The amount is based on the level of risk, type of coverage, and underwriting factors. Deductible. A deductible is the amount the insured must pay out of pocket before the insurance company starts covering a claim. Higher deductibles usually mean lower premiums. It's the insured's share of responsibility in the loss. Policyholder. The policyholder is the person or entity who owns the insurance policy. They are responsible for paying the premiums. They also have the authority to make changes or cancel the policy. Insured. The insured is the person, property, or entity that receives the protection under the policy. Sometimes the policyholder and insured are the same, but not always. If the insured experiences a covered loss, the policy pays out. Insurer. The insurer is the insurance company providing the coverage. They collect premiums in exchange for taking on financial risk. When covered losses occur, they are responsible for paying claims. Underwriting. Underwriting is the process insurers use to evaluate risk before issuing a policy. This involves analyzing things like age, health history, driving record, or property condition. The outcome determines if coverage is approved and how much the premium will be. Risk. Risk is the chance that a loss or damage might occur. Insurance exists to help people transfer financial risk to a company. Insurers measure and price risk using data and underwriting guidelines. Peril. A peril is the actual cause of a loss, like fire, theft, or windstorm. Different policies cover different perils depending on the contract. Understanding perils helps determine what events are insured. Hazard. A hazard is something that increases the likelihood that a peril will cause a loss. For example, poor wiring is a hazard that increases the chance of fire. Hazards are grouped into physical, moral, and morale categories. Loss. A loss is the financial damage or harm that happens because of a covered event. It could involve injury, property damage, or death. The insurer may compensate for the loss if it falls within the policy terms. Claim. A claim is a formal request made to the insurer to pay for a covered loss. The insured provides details and proof of what happened. The company reviews the claim and either approves, denies, or partially pays it. Claimant. The claimant is the person asking for payment from an insurance policy. It can be the insured or a third party who suffered damage. Their role is to provide information and documentation to support the claim. Binder. A binder is temporary proof of insurance while the full policy is being prepared. It gives immediate coverage for a short period. Agents or insurers issue binders when policies can't be finalized right away. Endorsement. Rider. An endorsement or rider is a written change added to a policy. It can add, remove, or modify coverage. Endorsements customize the policy to fit the specific needs of the insured. Exclusion. An exclusion is something that the policy does not cover. These are clearly listed to avoid confusion or false expectations. Common exclusions might include intentional damage or certain natural disasters. Coverage limit. A coverage limit is the maximum amount the insurer will pay for a covered loss. There can be separate limits for different types of claims or categories. Anything above that limit is the responsibility of the insured. Liability. Liability is legal responsibility for causing injury or damage to others. Liability insurance helps pay for medical bills, repairs, or legal costs. It protects the insured from having to pay those expenses out of pocket. Indemnity. Indemnity means restoring someone to the financial position they were in before a loss. The goal is not to let someone profit from insurance. It's a core principle behind most types of insurance contracts. Actual cash value, also known as ACV. Actual cash value is the value of an item after subtracting depreciation. It reflects what the property is worth today, not what it cost new. Insurers use ACV when paying certain types of claims. Replacement cost. Replacement cost is the amount needed to replace damaged property with new items of a similar kind and quality. It doesn't subtract depreciation. Policies using replacement cost typically cost more, but pay more at claim time. Subrogation. Subrogation lets the insurer go after a third party who caused a loss after paying the insured. This helps the insurer recover money the company paid out. It prevents someone from getting paid twice for the same incident. Reinsurance. Reinsurance is insurance for insurance companies. It helps insurers share or transfer large risks so they don't take a massive loss from a single event. It keeps the insurance system stable and solvent. Coinsurance for property. In property insurance, coinsurance means the policyholder agrees to insure the property for a certain percentage of its value. If they don't meet that percentage, they may be penalized on partial losses. It encourages people to carry enough coverage. Coinsurance for health. Coinsurance in health insurance is the percentage the insured pays after meeting their deductible. For example, someone might pay 20% and the insurer covers 80%. It continues until the out-of-pocket maximum is met. Copayment. A copayment is a flat fee the insured pays for a health service, like $30 for a doctor visit. It applies even after meeting the deductible. It's a way to share costs between the insured and insurer. Aggregate limit. An aggregate limit is the total amount an insurer will pay for all claims during a policy period. Once that limit is reached, no more coverage is available. It applies across claims, not just one incident. Occurrence. An occurrence is an event that causes injury or damage. It could be something sudden, like a car accident or storm. Some policies pay based on when the occurrence happened, not when the claim was filed. Named insured. The named insured is the main person or business listed on the policy. They have the full right to make changes, file claims, or cancel coverage. Their name appears on the declarations page. Additional insured. An additional insured is someone added to the policy for coverage, even though they aren't the main policy holder. This is common in business contracts and leases. They get protection, but don't control the policy. Beneficiary. A beneficiary is the person who gets paid when the insured dies under a life insurance policy. The policyholder chooses who that is. Beneficiaries can be individuals, trusts, or organizations. Actuary. An actuary is a math and statistics expert who helps insurers calculate risk. They set pricing based on data like age, claims history, and probability. Their work ensures the company can pay claims and stay profitable. Adverse selection. Adverse selection happens when people with higher risk are more likely to buy insurance than low-risk people. For example, a sick person is more likely to buy health insurance than someone healthy. Insurers fight this through underwriting and pricing. Moral hazard. Moral hazard is when someone consciously and intentionally behaves riskier because they have insurance coverage. For example, filing false claims or being careless because they expect payment. Insurers manage this with deductibles and investigations. Moral hazard. Moral hazard is the unconscious and unintentional carelessness or indifference toward risk because someone feels protected by insurance. It's not intentional fraud, just a lack of caution. Physical hazard. A physical hazard is something tangible that increases the chance of loss. Examples include slippery floors, old wiring, or poor maintenance. Insurers look for physical hazards during inspections or underwriting. Underinsured. Underinsured means the person has coverage, but not enough to fully cover a loss. This may result in out-of-pocket expenses. It often shows up in auto and property claims. Uninsured. Uninsured means having no insurance coverage at all for a specific risk. In auto insurance, uninsured motorists cause major financial problems for others. Some policies include protection against uninsured drivers. Grace period. A grace period is extra time given to pay a missed premium before the policy lapses. Coverage usually continues during this time. If payment is made before the end, the policy stays active. Lapse. A lapse happens when a policy ends because the premium wasn't paid. Once lapsed, coverage stops and claims won't be paid. Some policies allow reinstatement if the insured acts quickly. Renewal. Renewal means extending a policy for another term once it expires. It might renew automatically or require new paperwork. Premiums can change at renewal based on new risk factors. Cancellation. Cancellation is when a policy ends before its term is up. It can be initiated by the insured or the insurer. Reasons might include non-payment, fraud, or changes in risk. Non-renewal. Non-renewal is when the insurer decides not to continue the policy after it expires. It's not the same as cancellation. Insurers usually must give advance notice of non-renewal. Declarations page. The declarations page is the summary sheet at the front of the policy. It lists names, coverages, premiums, limits, deductibles, and policy dates. It's the snapshot of the contract. Insuring agreement. The insuring agreement explains what the policy actually covers. It outlines the insurer's responsibilities and promises. It's one of the most important sections to understand. Conditions. Conditions are the rules and duties the insured must follow for coverage to apply. They might include reporting losses, paying premiums, or preventing damage. If conditions aren't met, claims may be denied. Waiver. A waiver is when the insurer gives up a right voluntarily. For example, they might not enforce a technical rule in a certain case. Once waived, they usually can't enforce that right later. Estoppel. Estoppel prevents someone from going back on something if their actions caused another person to rely on it. In insurance, if a company acts like something is covered, they may not later deny it. It protects policyholders from unfair surprises. Consideration. Consideration is what each party gives in an insurance contract. The insured gives premiums and truthful information. The insurer gives the promise to pay covered claims. Contract of adhesion. A contract of adhesion is a take-it-or-leave-it insurance contract written by the insurer. The insured doesn't get to negotiate the terms. Any unclear language usually benefits the insured. Aleatory contract. An aleatory contract is based on uncertainty because one side may get more out of it than the other. You might pay for years and never file a claim, or file a claim early and get a big payout. It depends on chance. Utmost good faith. Utmost good faith means both sides must be honest and disclose all important information. Insurance relies heavily on trust. If someone lies or hides facts, the contract can be voided. Insurable interest. Insurable interest means you must have something to lose financially in order to insure it. You can't insure just anything or anyone randomly. This prevents insurance from becoming gambling. Replacement cost value, also known as RCV. Replacement cost value is what it would cost to replace damaged property with new items today. It does not subtract depreciation. Many homeowner policies use RCV instead of ACV, also known as actual cash value. Depreciation. Depreciation is the decrease in value over time due to wear, age, or use. Insurers subtract this when calculating actual cash value. It reflects what the item is realistically worth now. First-party coverage. First-party coverage is insurance that compensates the policyholder for losses to personal property or for direct expenses they incur. Claims are made to the policyholder's own insurance company, which pays the benefits directly to the insured. An example would be collision coverage, that pays to repair damage to the insured vehicle when the policyholder causes an accident. Third-party coverage. Third-party coverage pays others if the insured causes damage or injury. Liability insurance is the most common example. It protects the insured from paying out of pocket to others. Rider A rider is an add-on to a policy that changes or enhances the coverage. For example, you might add a child rider or accidental death benefit. It customizes the policy to personal needs. Warranty. A warranty is a condition that must stay true for coverage to apply. If it's broken, the insurer might deny a claim. Not all policies use warranties the same way. Deductible waiver. A deductible waiver is when the insurer agrees not to apply the deductible in certain situations. It may apply to specific coverages or claim types. It reduces out-of-pocket costs for the insured. Experience rating. Experience rating adjusts premiums based on the insured's past claims history. If claims are high, premiums go up. If low, they may go down. It's common in workers' compensation and commercial insurance. Loss ratio. Loss ratio compares the amount paid in claims to the amount collected in premiums. A high loss ratio means the insurer is paying out a lot. It helps insurers measure profitability. Combined ratio. The combined ratio includes both losses and expenses compared to premiums. If it's over 100%, the company is losing money on underwriting. It's a key financial indicator for insurers. Exposure. Exposure is the likelihood or possibility of experiencing a loss. It refers to the risk an insurer takes on when writing a policy. More exposure usually means higher premiums. Catastrophic loss. A catastrophic loss is a major event that causes a large number of claims at once. Examples include hurricanes, wildfires, or earthquakes. Insurers prepare for these events with reinsurance and reserves. Risk pooling. Risk pooling means spreading risk across many policyholders. Everyone pays into the pool, so no one person bears the full cost of a loss. It's the core concept that makes insurance work. Self-insurance. Self-insurance is when a person or business sets aside their own money to cover potential losses instead of buying insurance. It's common for large companies to have predictable risks. It avoids paying premiums but carries more financial responsibility. Stop loss. Stop loss is a feature, usually in health or self-insured plans, that limits how much someone has to pay out of pocket. Once the limit is reached, the insurer pays 100% of the remaining costs. It protects against very high expenses. Aggregate deductible. An aggregate deductible is the total amount a policyholder must pay in a policy period before the insurer pays. Instead of applying to each claim separately, it applies across all claims. It's often used in health and commercial policies. Umbrella policy. An umbrella policy provides extra liability protection beyond existing policies. It kicks in when underlying coverage limits are exhausted. It's a safety net against large lawsuits or settlements. Broker. A broker represents the customer, not the insurance company. They help clients find coverage from different insurers. They typically earn commissions from the policies they place. Agent. An agent is licensed to sell insurance on behalf of one or more insurance companies. They explain policies, gather information, and help people apply. Agents can be captive or independent. Captive agent. A captive agent sells insurance for only one company. They know the company's products well but have limited options. Customers relying on them only see that carrier's offerings. Independent agent. An independent agent sells insurance from multiple companies. They can shop around for the best rate and coverage. They own their book of business and work with several carriers. Exclusive agent. Exclusive agent is another term for captive agent. They're tied to a single insurer. They can't offer policies from other companies. Adjuster. An adjuster investigates claims to determine what happened and how much should be paid. They gather evidence, speak with involved parties, and estimate damages. They work for insurers, claim services, or independently. Public adjuster. A public adjuster is hired by the policyholder to help with a claim. They negotiate with the insurer on the customer's behalf. They're often used in large or complicated claims. Claims-made policy. A claims-made policy covers claims only if they are made while the policy is active. It doesn't matter when the incident happened, as long as it's after the retroactive date. Professional liability insurance often uses this format. Occurrence policy. An occurrence policy covers incidents that happen during the policy term, even if the claim is filed later. The timing of the event, not the report, determines coverage. Many general liability policies use this type. Retroactive date. The retroactive date is the earliest point in time a claims-made policy will cover events. Claims for incidents before that date are not covered. It helps limit the insurer's exposure to old risks. Tail coverage. Tail coverage lets someone file claims after a claims-made policy ends. It covers incidents that happened while the policy was active. It's often bought when switching jobs or retiring from certain professions. Assignment. Assignment is when policy ownership or benefits are transferred to someone else. Some policies allow it, others restrict it. It must follow policy rules to be valid. Binding authority. Binding authority is when an agent has the power to start coverage on behalf of the insurer. This allows them to issue binders or temporary policies. Not all agents have this authority. Premium loading. Premium loading is the additional amount added to an insurance premium to cover administrative costs, profit, and contingencies. It's how insurers account for expenses beyond just the expected loss. Understanding premium loading helps when calculating premiums and evaluating policy costs. Replacement policy. A replacement policy is a new policy that takes the place of an old one. It may offer different terms, pricing, or coverage. It's common in life, health, and property insurance. Reinstatement. Reinstatement is restoring a policy after it has lapsed. The insured may need to pay overdue premiums or provide new information. Not all policies are eligible for reinstatement. Surplus lines. Surplus lines insurance is sold by non-standard or non-admitted carriers. It's used for high-risk or unusual situations that regular insurers won't cover. Agents must be specially licensed to place this type of policy. Admitted carrier. An admitted carrier is licensed by the state to sell insurance. Their policies are backed by the State Guarantee Association. They must follow state regulations and rate approvals. Non-admitted carrier. A non-admitted carrier isn't licensed in the state, but can sell surplus lines coverage. Their policies aren't backed by guarantee funds. They offer unique coverage when admitted carriers won't. Guarantee Association. A guarantee association protects policyholders if an insurer becomes insolvent. They step in to pay certain claims or transfer policies. All admitted insurers pay into this safety net. Commission. A commission is the payment an agent or broker receives for selling a policy. It's usually a percentage of the premium. It motivates producers to market and service policies. Earned premium. Earned premium is the portion of the premium the insurer has earned over the time coverage has been in force. If a policy is halfway through its term, about half the premium is earned. It reflects the coverage already provided. Unearned premium. Unearned premium is the portion of the premium not yet earned because the policy is still active. If a policy is canceled early, the unearned part may be refunded. It's considered a liability on the insurer's books. Policy term. The policy term is how long the policy lasts, like 6 months or a year. Coverage is only active during that time. At the end, it can renew or end. Underwriting guidelines. Underwriting guidelines are the rules insurers use to decide if they'll issue a policy. They cover eligibility, pricing, and risk factors. Agents and underwriters use them to make consistent decisions. Fraud. Fraud is intentionally lying or deceiving to get insurance money. Examples include staging accidents or exaggerating claims. It's illegal and can lead to denied claims or criminal charges. Salvage. Salvage is the remaining value of damaged property after a claim is paid. The insurer may take ownership and sell it. It helps the company recover some of the loss. Total loss. A total loss occurs when insured property is either destroyed or the cost of repair is greater than its actual value. In this situation, the insurer typically pays the vehicle's or property's full insured value or policy limit, and whatever remains may be treated as salvage. Partial loss. A partial loss is when property is damaged but can be repaired. The insurer pays for the repair up to policy limits. Most everyday claims fall into this category. Catastrophe. A catastrophe is a large event that causes many claims at once. Insurers track these separately due to their high cost. Examples include tornado outbreaks or major floods. Proof of loss. Proof of loss is a formal statement that the insured submits after a claim. It confirms details like what was damaged, when, and how much it's worth. Insurers use it to verify and process payments.